Hello, welcome to the Nest Edge. We are glad to be here this week. We name Nest Edge because we have a unique way of looking at the data that gives us an edge over the choppiness of the markets and the news cycle. So first off, I got to put all these disclaimers out. This is not advice. This is an educational webinar. Use this education as more to make more informed decisions. And again, this is just the way we do things. And the game of investing, there's many ways to win. There's many ways to lose. And so we're just discussing our processes. For those of you that have listened in the past and want to move forward and building your portfolio with us, please reach out to us at info@nestfinancial.net. We'll be happy to walk you through the process. I read recently where every one of us knows 152 people on average. So if someone in your circle needs to grow their knowledge in financial arena, please send them our webinar links. We'd be happy to have them as guests in our audience. This is a conversation between our portfolio manager, Sean McDougle. Hey, Sean.
Hello.
And myself, and inclusive of our audience. If you have a question, please add it to the chat box and the Q&A, and we'll be happy to address them. We are not making any recommendations, anything like that on the chat box or on this webinar. This is, again, just education purposes. The newsletter this week, Spiked Kool-Aid. I had a lot of fun reading this, Sean. This was a really good spin on how you wrote that.
I was trying to make it less boring. That's what I ended up with. Most of my topics are boring, so I'm sitting around. Usually I talk to my wife, and I'm like, how do I make this less boring? And she actually was, I'll give her credit for the frat idea. So I stole this 100% from Ash.
Good stuff. Sounds like you got some sirens behind you.
Oh, yeah.
This is a really interesting topic. And before I jump into this, you reminded me when I first came into financial planning back in 2000 timeframe. I remember getting into this and thinking the stockbroker name was really cool. And it's like, oh, this is so cool. And got into this stuff and quickly realized the first Thanksgiving dinner or first time my family got together, I started talking about everything I'm learning and everybody's eyes just glazed over. It was so boring. I'm like, oh, this isn't as exciting as I thought it was going to be. It's actually quite boring for most people. So
most people, yeah. I love it. It's like crack for me, but yeah, I realize I'm not, I try not to talk to people when I'm out, I just tell people I'm in finance because it's a lot easier to say that than either you're going to end up talking half an hour about, giving them ideas or helping them with something, or they're going to tell you why you're an idiot and why they're smarter than you. It's just like, no matter what, it's a lose-lose most of the time if you don't know who they are.
Yeah.
At least that's my experience.
I get you. Well, this is why we put these things together. So you and I can chat with each other and whoever wants to listen can listen and ask questions. This is a real interesting topic because it's the story of the last decade, I feel like. And I feel like we could argue that this is kind of a spillover from 2008. Meaning
similar game plan or game, playbook.
Yeah. So I would like to just start with if you'd give us a bit of history on the Fed spiking the Kool-Aid and how long it's been going
on. At this scale or at a level to where it really was the housing crisis, 08, 09, when the Fed stepped in for the first time and really, without, started printing money, like just handing away hundreds and hundreds of millions of dollars.
Right.
And at the time, compared to what we just did at COVID, it was actually not that much money.
Right.
But at the time, it was unprecedented.
There's an N in there somewhere.
Too much coffee.
Yeah.
It was a kind of a new thing at the time, and there was a lot of fears that it was going to cause massive 1970s level inflation, and it really didn't cause anything. It was pretty easy for us to work our way out of it, and it fixed some problems and things worked, but it created there's always side effects, and the new problem that it created is it made money super cheap, super free, and it caused a massive leverage problem.
Yeah.
And
well, go ahead.
No, sorry, I'm rambling. So happy to cover.
No, well, I was going to say, I mean, it you say we recovered, but the over the last decade, it's been hard to find yield in bonds and other things just because because rates have been low for so long.
Right.
And it's this fear of what you described in the newsletter, which is this Kool-Aid has been spiked and everybody likes that low rate environment. Everybody that's investing and getting money lent to them likes that. Except for if you're looking for the yield, which a lot of retirees need a bigger yield to depend on that money.
It's not as easy as it used to be. And yeah, the whole what's called normalization of interest rates, they've been chattering about that forever. And then, yeah, COVID definitely got in the way of that. I don't know if we're ever going to go back to normalization of like what we saw pre-housing crisis. And like, you're right, things have been artificially held down, and I don't like the genie's is out. So like, I don't know how you roll that back without like just massive impacts on, corporate America and so S&P 500. And I just don't think there's any politicians with the guts to do that. Right. I mean, I could be wrong. I don't know. This is just my opinion. I don't see it. Like, who wants to be the president who wants to be that guy?
Right. Unless it's in your last 4 of your presidency, last 2 years of your presidency, you're like,
I guess. Yeah. I mean, at some point there needs to be some normalization, but the argument is like, this is the new normal.
Yeah. Well, you touched on this at one of our last nest edges when we were talking about portfolios and the old portfolios that were the moderate portfolios that had all that, 45, 10 portfolios and they don't work anymore just because you can't get those rates of return.
Yep.
And that's how they were designed. So this is all part of the reasons why is because money has been, interest rates have been suppressed for so long. So I want to chat about corporate debt. You've talked about this also in our previous, webinars, being that thermonuclear bomb. You've talked about that in the past. So can you?
Yeah, they're intertwined. So what's been going on? So I'm going to back up for a minute. The Fed is doing a bunch of asset purchases. They're buying a lot of things we know about, and probably some things we don't, to keep bond prices up, therefore yields down, therefore interest rates down. That's why we've seen the largest expansion of S&P 500 corporate balance sheet in the history of history. It was in 2020. It was just a massive expansion of corporate debt. The problem with is a lot of that debt is not locked in. It's variable rates. So if interest rates start creeping back up, i.e. they let the bond yield move back up, and I know I'm jargage trained here. If interest rates start creeping back up, that's an immediate hit to corporate America's bottom line. So, and if you become less profitable, what the first lever they go to is usually layoffs. The second thing is once bonds, if they start looking risky, like oh wow, they were barely getting by as it is. Now their interest rates are going up. They were losing money. Then their bond values fall through the floor, and then you could start seeing some unraveling in the bond market. It'll start in the junk, and then it could spread into, high, from high yield over to corporate side, the higher quality. It can go fast. The thing is that makes me sleep a little better about that, that thermonuclear bomb is the head of the Fed, Powell. He's a private equity guy. He's very aware of this problem. In my opinion, he definitely doesn't want it to happen on his watch as well. He wants to exit left stage, and then the next guy is inheriting a mother of a problem. I don't know how they unfuse this without, massive amounts of blood, but that's how it kind of intertwines. Is the Fed is keeping rates down, so corporate America is getting fat on debt to either expansions or
buy other companies and
buy other companies.
Yeah, for sure.
Share buybacks. There's various things that you can do with it, but
it's more of a double whammy if interest rates go up, then it starts, it as you pointed out, it starts making them harder to pay their obligations, but then also their stock prices go down. So there's just fear all the way around and can cause a
the volatility. It's very common for bond volatility to go from the bond market over to equities. Very rarely do we see equity volatility get pulled over to the bond side. But if bonds start melting down, like your bond's worth nothing, what do you think their stock's going to do?
Right.
I mean, that goes real fast. That transition from bonds to equities is real fast. It's the other way. Does it not as much because there's stocks is so newsy. I've said this many, many times throughout the years, but like the bond market is way bigger than the equity side, and it's got way brighter. If the bond market starts going crazy, that's when you get nervous. Like, oh shit, something's actually happening here. You see the real trouble in the bond space and the currency space first if it's something serious.
Yep. No, that makes sense. So we're here now. So, 2008 to 2021, and we're in this
the tapering
mess. And so we're in this tapering thing. What's the best way? You just said you don't know how we do it, but if you had to do it, what's the best way to do it?
Slowly, and then just let equities. I mean, there's no great way. I mean, you kind of do the same playbook that they eventually were able to taper off of it coming out of the housing crisis. Eventually just took, I don't know, 2 to 4 years. I can't remember the exact timeline, but it took years because you like my little narrative that me and my wife came up with. You got a bunch of drunk frat guys on Wall Street. And so you got to like slowly wean them off of this free cash and let things get priced in because so equities, they will forward pull in expectations in a heartbeat if you get too aggressive. Now, I think it's, less likely that things are going to happen really, really fast with, this week's CPI print. So it will be a little longer cooling, not with inflation. That's definitely not cooling. But this whole tapering argument, you probably haven't seen a whole lot about in the last few days because with the cooling inflation number, they're going to be like, okay, the Fed's going to be less worried. The Fed does not want rampant inflation. So if they saw a massive jump in inflation, they're going to, okay, now we have to start tapering off even more to stop pumping money into the economy or wherever there's, whoever's selling those bonds to the Fed. A lot of that is going right back into the stock market. I mean, like the last year, like go look at the last trailing, 24 months of the S&P. Nature in the stock market doesn't do anything in straight lines, but the S&P is within reason been on an eerie straight line since, the lows of the pandemic. And a lot of that is, they're pumping hundreds of millions of dollars every month out there. And a lot of that's just, people are selling off treasuries and then funneling that back into X, Y, Z.
Making money. They're like, this is making money. I'm going to throw that money in there for sure.
Yes.
So you mentioned cooling off of inflation, and this is something I wanted to touch on. What did the inflation numbers tell you? Was it 5.3 that came out? Is it what it was?
Yeah, it's been elevated for months. It was, we expected a bit of a pause this month, and we're expecting it to pick back up next month. Nothing happens in a straight line that's not being artificially monkeyed with, and they are definitely messing with inflation numbers. And even at their best efforts, there's still going to be, cooling and acceleration and consolidation periods. And that's really all this is we've been on such a rampant run up these last 3-4 months that, a month where it's still high. Like
5.3. Yeah.
I mean, according to their numbers,
what they're saying.
Yeah, it's still high. But if you went like 2 years ago and I said inflation is going to be 2.3, you're going to be like, what? Like the Fed has a mandate. They're trying to get to 2. Like that was their goal under their numbers. But like 5.3, they're just, it's still a big number. It's just not as big as expected. That whole as expected. It's like, who cares what's expected? I mean, it's today's news. Who cares about it? No one will care tomorrow.
Well, and as you pointed out in the past, it's how they're measuring that number too. I mean, they're not measuring it by how they were measuring in the 80s or 90s. Yeah. So if you and I were looking at some charts earlier, but if they were measuring it to like the 80s, it one could argue that it's at like 13 to 14%.
Somewhere in that neighborhood. It's much higher. Yeah.
Yeah.
I mean, if you're just a normal human being living your life, you can't tell me that you haven't seen any price pressure going up in the this year. Like, I feel like every other week I'm getting an email saying, hey, our prices are going up for X, Y, and Z.
Right.
Today, I got an email from my barber saying prices are going up. Like that's inflation. Is that counted in CPI? No. Right. I mean, but it costs me more money to get the same goods and services.
Yep.
So I'm not the only one getting these emails and these notices. Cost of living is going up. If you live in Austin, it's not getting cheaper. Yep. Promise, it's not.
Right. There's some more rumblings. There's rumblings of and it's not super big news at the moment because people don't seem to care about this at any point in time too much because they just think it's political, and at some point it is. But rumblings of the debt ceiling that need to be raised, and of course that's a political situation. What kind of impact do you expect from that?
I don't know. At the end of the day, when you start waiting, and this is again, I don't take into an account what Washington is or is not doing within reason. I have to be, you need to be aware of it, but you can't make trades based off of what politicians are doing. But the whole debt ceiling thing, I agree with the general theory or thought process. This is a political game. It doesn't matter. It's like who's in office and who's not in office, and the other side is going to hold out saying, no, we're not increasing, just to get something else that they want. That's the easy. Yeah. It's, I think we talked about this yesterday. Like the older I get, and I'm not that old yet, but like I'm way less interested in politics than I used to be. It's just like, this sucks. Like, it's like both sides, every side. I don't know. Like, it's so much misinformation. It's like, I don't.
It's hard to know what to trust, for sure.
Oh, it's disgusting and gross. Not a fan. And the older I get, I don't even want to see myself in 10 or 15 years. I'm just going to.
Already getting bitter.
I am, or annoyed. I guess just annoyed. It's like, how did they just get so shady? And no matter which way you lean, I was like, I don't really like anybody. I was like, I don't know who to trust or not to trust. I don't know any of these people. I don't know anyone that knows any of these people.
It definitely seems archaic because, I feel like, as with anything, society is always evolving. It's moving fast. Technology's got this thing, and I forget the term, but there's a term where technology just doubles every 18 months. And, we catching up with all technology and all the things that we have at our fingertips now that we didn't before. But the one thing that hasn't seemed to keep up with everything is politics. Politics now is super slow. It's always been slow, but now it's super slow. And I
think that will eventually change. I think, and again, this is me. This is just my opinion. There's this, the baby boomer generation is, that's one place they still have a big grasp, control over his politics. I mean, like, what's the average age and background of your, politician in Congress? They're probably all, white old dudes. Like, I don't know, 8 out of 10. I don't know those statistics at all. I'm just going off of who I see talking often. It's white old dudes, and they have their way of doing things that it's worked in the past, but this is a different world. In my opinion is that we will start seeing massive cultural significant changes that eventually are going to get pulled into Washington. I mean, maybe 20 years. I mean, because what you need is a millennial wave we're too young now. I mean, technically I'm a millennial. I don't know how, but if you're born in 85, you're a millennial. You just need my age group to get, another 10, 20 years to where we are taken seriously enough to where we can start running for Senate, House,
making some changes. And this again just talks to the evolution of mindset. Yeah. So nothing to expect other than going back to the question of debt ceiling.
Short-term volatility, and usually in the past, I know it's Christmas 2018, and I think we had one that shut down in 2019 somewhere. Just create short-term volatility, and just like I use it as I usually will get things that I like for cheaper. It's it's a lot of short-term noise. It doesn't really impact as much as you think. It sucks if you work for
government, not getting
government. You don't get a job, or you don't get a paycheck. That sucks. But how it massively impacts the economy. Now, if it drew out for months and months and months, then it would start affecting the data, and then we would start reacting to that. But like trying to,
a 2 or 3 week shutdown is just volatility. And better pricing.
Yeah, better entry points for things that we already like. That's generally how it works out. Now, every time can be different, but that's how I I view it.
Makes really sense. Another thing that I read recently, and just kind of catching everybody up on the news, that what I think are like big spotty events that we wanted to draw attention to, is there's rumblings of Evergrande, this big real estate organization in China, that there's some comparisons online of it being similar to a Lehman Brothers as far as size. See, Lehman Brothers was a $600 billion meltdown. This has got 300 billion in debt and 200 billion in assets, but also they can't pay their bills now. How does that impact the U.S. and more specifically our portfolios?
Our portfolio is zero. We have zero Asian exposure, zero emerging markets exposure. We're actually China and Japan. They're in what we call Quad 4. So slowing inflation and slowing growth. Remember, China is kind of taking an overly simplistic view of the waves of COVID and economic expansion. They are at least 6 months ahead of us. So they have kind of rolled over this hill that we're about to probably roll into of a slowdown. And that's kind of when you see things go sideways, is when there is some external force that, like the classic, the water recedes and you see who has no shorts on. Mm-hmm. That's usually when things go sideways. Great example of that is Bernie Madoff. Mm-hmm. If it wasn't for 08, 09, that whole, volatility, probably never would have known. He would have kept getting away with it. And that's probably the best, my view of this. I don't know a whole lot about it. I do know that they're like the second largest. They make apartments. They're a big time player in apartments over there. Now you may know more than I do about this. It's okay. That could be something. But we have zero exposure to China and have it in 6 months. Okay. Economically, they're in a slowdown. So we got out of there. Like I said, they're on a short list for us to even start shorting them. But
speaking of quadrants, where do you see us right now in the U.S.?
We are it is probable currently we're in Quad 3. Rising inflation, slowing growth. We're on a knife's edge between Quad 2, Quad 3. The difference in between those two things is what's growth's doing. I think we're on a knife's edge. We're probably not going to see the massive rip that we saw, like economic or inflationary growth that we saw at the end of 2020, the beginning of 2021. But there could be some windows of time where we get more aggressive in Q4 of this year. Definitely not Quad 4. That's bad. That's everything goes down. Everything sucks.
Yeah, the difference is Quad
massive. Q. Yeah. It does get confusing. But yeah, Q4 of this year. So November, December of this year, it is possible that we do slide back into what's Quad 2, which is inflation and growth start accelerating at the same time again. And that's a great environment to make money. Now, we'll see. We need the data to confirm.
Yeah, and the reasons for that, is it just holiday shopping and things of that nature, you think? Or what is the thought process?
It is the knife's edge thing is the year-over-year comps are a little easier, and the Fed not slowing down their purchases, and just the signal, the market signal is there's this. Everybody keeps calling for like a 10% correction in equities domestically. I'm not saying they're wrong. I'm just saying if you keep saying that thing long enough, I guess eventually you'll be right. But like every indicator that I look at is, and this is backed up by our research providers, and everyone's kind of saying, it's like, look, this thing's still got some legs. Like there's still going to be some run, and especially if we slide back into what we view as Quad 2. Like we could have a nice little finish into the end of the year, like the Santa Claus rally. I don't believe in that whole shenanigans. There are some fundamental reasons why it works sometimes, but I will never buy because Santa's coming.
Right.
Go back to as recent as 2018. That shit didn't work. So as of right now, our game plan is do things that do well in Quad 2 or Quad 3 and keep a real close eye on what the GDP numbers are going to be coming out, and we could get very aggressive again at the end of this year. We'll see.
What things do well in Quad 2, Quad 3? What type of positions?
Energy, tech, commodities, depending on the signal. The things that we're staying completely out of. The big difference between quad 2 and quad 3 is gold. Gold loves quad 3, hates quad 2. So that is something that we have been in for let's call it a month or two, but we've started fading out of it recently just to trim our risk, our exposure in case we do slide back in quad 2. I don't be sitting there holding a bunch of gold because it'll blow you up.
Right. Makes sense. Any questions from the audience? We've got a few more minutes. I see Hector from Puerto Rico. Hector, how are you doing? Hopefully things are doing well in Puerto Rico. I don't see any other questions, but
I answered all the questions too well.
I think I'm looking at where we got our positions.
Probably not.
And we've talked about inflation, and so we're those are the positions that we're in. I don't see any other questions. So.
Yeah, I mean, I could skim through the models, but I mean, nothing substantially has changed. I mean, we're somewhere between 35 and 55% equities. A lot of that is, we do have quite a bit of European exposure: Netherlands, Germany, Switzerland, Russia, energy. We have been adding industrials lately and trimming utilities just in case. Industrials likes quad 2 and 3. Utilities is another one of those things that likes quad 3, does not like quad 2. Mm-hmm. So we're trying to reduce our exposure because we really don't know which way we're going yet. We just want to kind of hedge our bets. Natural gas is absolutely on a tear. Mm-hmm. That's been a great one.
And these are commodity prices you're talking about?
Yeah. Yeah.
One thing that related to inflation and some commodity prices that we were just joking and surprised about yesterday was container shipping costs.
Oh, yeah.
You want to touch on that for the audience? How the cost has gone up?
Yeah, according to our research provider, the depths and the understanding of the container world is something I do not specialize in, but I just have to go off of what is told to me, and I have a very crude understanding. A 40-foot shipping container coming from Shanghai to LA, the price has gone up 8x since pre-pandemic levels. Wow. I think it just came in as of last week. I don't know where the price is as right now, but as of last week, it was just under $12,000 a container. Wow. So just, for multiple reasons, but
you say that in the image that pops in my head is a container ship with all these containers that are flying off into the ocean. Like, whoa, that was 12,000. That was 12,000.
That would suck. Yeah. Not counting all the, the goods that are inside, how much money you're losing, but you're losing. Sure. Inflation's not transitory. So I'm so tired of that argument. It's like, it's just transitory. It's transitory. It's like, it's been going for over a year.
Well, back to the name of your article, it's one of those things. Once you increase prices, once your barber increases his prices, he's not going to lower those next year.
No,
it's just not going to happen.
No, he's not. I'm not getting an email in 6 months saying, "Just kidding."
Yeah, certain things will go back down. I think your obviously your commodity prices may go back down, right?
Yes, those are actively traded.
Once those costs have been borne by the small business owner, he or she's not going to come back and say, let me reduce these prices. It's just not going to happen. So transitory, back to your argument of transitory, I just don't see it. I don't see it at all.
I completely agree.
Very cool. Well, that's it for our time. It's 12:59. Thank you all for attending the webinar. Once again, this isn't investment advice. It's rather a conversation between how we do things and how we look at it between Sean and I. It's education in nature only. If, however, you want to discuss how we do things or interested in anything else we can help with, please let us know. If after this you want a recording, just know that you'll get one and we'll have them posted on the website as well. Have a wonderful rest of your day. Bye, Sean.
Adios.